Well, good morning, Carly Bowans. Oh, guys, don't you love this vibe that's happening here?
I do.
Okay, guys, welcome to the first ever EasyCrypto conference that's brought to you by EasyCrypto and EasyEquities. Today, we're going to have a jam-packed session with special guests, authors, Carly Bowans.
I'm here.
CEOs,
that's all that you really need. And you.
Thank you for not forgetting about me. Okay, guys, so, Carly, do you know how many EasyCrypto investors we have on the platform?
I'm one, so that's one.
Okay, thank God. Otherwise, I was going to kick you off here.
I'm going to go with 80,000.
Okay, you're being modest. Try again.
Okay, 92,000.
Okay, no, Carly's being really modest. We've got over 127,000 EC10 crypto bundle holders. So that's a big number.
Damn, we've got some fans out there. I didn't realize.
Yeah,
that's
so
cool.
Guys, if you've never heard about the EasyCrypto 10 bundle, it is available on the EasyEquities platform. It is a bundle, remember? And yeah, you can invest in it, and it's got the top 10 cryptocurrencies around the world that's weighted by market cap. So Carly, I think we should get this show on the road.
Yeah, let's do this.
But first, I think we should do some housekeeping.
Okay, let's do some housekeeping. So guys, first of all, we are running a competition today for 5 big ones, 5,000 bucks. We're going to give that to someone who tweets about the conference using the hashtag EasyCryptoConference and tagging EasyEquities and EasyCryptoSA. So please, if you learn something cool, if you hear a quote from an awesome speaker, please tweet it. We love sharing the love with our community and for those who can't be here. So let's get some buzz going on the Twitter sphere. Let's do it.
So guys, head over to those socials. And if you're looking for education, more education, a few research pieces, we've got a research portal which you can head to. We've got a blog portal, and we've got the Easy Academy that can help you from the A's all the way to the Z's about investing.
And let's not forget about our FAQ portal. So guys, if you have a question about crypto or EasyEquities, go and check out support.easyequities.co.za. And you haven't even mentioned your really cool podcast. I thought this was your thing.
Oh yeah, come on, Carly.
That's why I'm here.
Anyway, she's putting me on the spot. But guys, we have a really cool podcast called Easy Does It. If you really want to learn about education, it's all there on the podcast. It's all on your favorite streaming sites. So head over to Apple Podcasts or Spotify, and it's there. And just press play. So let's get the show on the road. First up, we've got Rob Graham, the VP of Finance at Purple Group, and he's going to take us through the basics of crypto. We've got a few questions lined up for him, and if you do too, please ask them in the Q&A section. See you soon, guys. Guys, I told you I'll be back very soon. I am with the VP of Finance, Rob Graham. How's it, Rob?
Very well, thanks, and you?
Nice to see you here.
You
so
too.
Guys, I'm going to start it off with a random question for Rob, and not just to jump straight into it. So if you were going to have your own crypto coin, what would you call it?
I had to do quite a bit of thinking, and I'm glad you guys are the marketers and not me, because I'm clearly not very good at it, but the best I could come up with was maybe ICE, or Smoothie Coin, and I actually looked on CoinMarketCap this morning, and those are already taken, so it's not the most original. But my thinking is, if you drink a smoothie, you can imagine you taking all of this clunky food and you're processing it, which makes it really easy to drink and digest, and that's kind of the point of crypto at the end of the day, to remove friction in the financial system, make things a lot faster, smoother, easier to consume. And yeah, that's what I came up with. So.
Okay, I thought you were going to go with a more surfing name, because I know you're big on surfing. So
yeah, maybe.
I'll give you 4 out of 10, but
Thanks.
it's okay. So anyway, I'm going to ask you, Rob, are you investing in crypto at all?
Yes, I am. Only the EC10. Yeah, it's just, to wind the clock back a bit, if you look at all the coins that were in the top 10 in 2017, There's only about 4 of them left, being Bitcoin, Ethereum, Ripple, and Cardano. And most of the ones that were very popular at the time, like Zcash and Dash and Monero and all of these other coins, they've kind of washed away and fallen very far down the rankings. And the space is very much still based on hype. And so what you're seeing is all these new coins coming into the top 10 all the time, and then they do really well, and then some of the other ones are falling out. And the EC10 is really a very good way to always make sure you're invested in like the top 10 best performing cryptos. And so I've just made my life easier and just, kept just keeping the EC10 as my only investment. It makes my life a lot easier, and yeah, so that's what I'm doing.
So let's circle back there. You mentioned cryptocurrencies and coins. What exactly is cryptocurrency?
So cryptocurrency, I guess it refers to the industry as a whole, and then of course within that, what's really been the biggest innovation is Satoshi Nakamoto, who was the inventor of crypto, managed to get the system right. And there's really quite a few different components to the system that make it work the way in which it does. People have tried this in the past, and the coins they never worked for various reasons. And it's actually one of the reasons Satoshi didn't come out with his normal names. He used a pseudonym because of what's happened in the past before crypto was working the way it is. There was a lot of crime and issues around it, regulatory concern. So Satoshi kept the pseudonym, but then he got it right, and he managed to invent Bitcoin, which was the first cryptocurrency. And yeah, what made that work is it really, I guess there's 3 pillars to it. There's the network component, which is a peer-to-peer network where people can come and go and join, and it's free and permissionless to join the network. And then there's the miners. The miners are they're like computers all around the world that connect to this peer-to-peer network, and they process transactions. So miners, it's not really the best term. They should actually be called transaction processors. So that's the second component. And then the third thing that makes it work is, I guess, the people who process transactions, and yeah, that gets processed into the network and onto the ledger. That's the other component, is the ledger, which is the blockchain. So you've got the blockchain, the network, and then the miners who process the transactions. So those 3 things coming together is really what made cryptocurrency work for the first time. And that was a massive breakthrough. And since then, I think there's about 18,000 cryptos at the moment. So everyone's then gone and kind of looked at the model being Bitcoin, and they've created a lot of other coins using the same kind of breakthrough.
So now that we've got the cryptocurrency definition down, you used a lot of lingo, a lot of jargon over there. And at Easy, we like to keep it super easy. So let's debunk these words a bit. And I want to start off with the word Bitcoin, because you mentioned it. What is Bitcoin?
Yeah, exactly. So Bitcoin was the first crypto that was invented, like I said. And yeah, it uses the blockchain ledger, which is really, you can go back from the very first transaction and follow all of the transactions through that have ever happened. It's completely visible to the public. And Bitcoin, yeah, that's the big daddy. I think it accounts for about 55% of the market cap is all in Bitcoin at the moment. And yeah, Bitcoin was just the first crypto that started it all.
Got it. And in your definition of Bitcoin, you use the word blockchain. What exactly is blockchain?
So blockchain, it's really the ledger or the accounting system that powers Bitcoin, and it's just a database. So if you think of historically, we've had different types of databases, SQL being the most popular, that's used by banks and the internal databases and all companies really. And blockchain is just a different type of database. And so what happens is, so in Bitcoin, the blocks are 10 minutes long. So really what happens is people will process transactions. I'll send you money, you send me money. Everybody's transacting for a period of about 10 minutes. Then all of those transactions get put into a block. So that is where the block part comes from. It's like a batch of transactions that then get processed, and then once that's done, that gets kind of stamped or signed off by all of the transaction processors in the network, and then it gets put in a chain. So then that block becomes, another one will get attached, and so the blockchain continues. So it's really just an accounting system.
Right, makes sense. And before this conference, I was actually on social media, and I recently saw that the EC10 bundle is taking a dip. And there's a term or there's a phrase that people love to use, and it's called BTFD, buy the dip. What exactly is that?
Yeah, I guess people are always saying, buy the dip. It's a good opportunity. You should never really buy when prices are high because, you should be selling when prices are high. So when prices are low, especially in crypto, it can be so volatile. People get very fearful and, everyone wants to panic sell, but it's kind of a meme where people are saying just buy the dip and hope that it's always going to go up, which of course isn't always the case with some of the coins, obviously. But yeah, that's kind of the meme, buy the dip.
Oh, now I really get it now. And you used another phrase earlier, and you said they should actually be called transaction specialists or something like that. But what is mining?
So the term mining comes from, when Bitcoin was first created, well, how it works is, so those blocks I was speaking about every 10 minutes. So there's different people being the miners or the transaction processors competing to sign off that block as being done, so to speak. And there's a whole bunch of complicated like maths and stuff that makes that work. But those miners, when they finish a block and they win the puzzle, so to speak, then they get some Bitcoin given to them. And when Bitcoin was first created in 2008, every 10 minutes someone would win a block, so to speak, and they would get 50 Bitcoin as a reward, as a subsidy for doing the work and providing that service to the network. Because the miners are, they use electricity, they run big data centers and computers, it costs them money to provide that service to the network. So it's really a reward that gets paid to the miners. So yeah, and then every 4 years it's being halved. So it went from a 50 Bitcoin reward to 25 to 12.5. And at the moment we're sitting at 6.25 Bitcoin every 10 minutes. So yeah, these transaction processors are providing the service to the network, and then that's how they get paid.
Okay, makes sense. And in my build up to this conference, I was literally looking at every YouTube video, podcast, and there's a term they use quite a lot, and it's decentralized. And I was just hoping that you could debunk that word for myself and the EasyVestors that are on this conference.
Sure. So earlier I mentioned the peer-to-peer nature of Bitcoin, and we've been speaking about the miners or the transaction processors now, and they are all over the world. So they are distributed across geographies, different countries, and they can join this network as they want, and then they can help process transactions. And that's really why it's decentralized, because there's no single point of failure. If one data center goes down, or like in South Africa, we've got load shedding, when Eskom decides to turn off the power, the Bitcoin network doesn't die because there's still other people all over the world who are maintaining the network and processing transactions. So that is where the term decentralization comes from. And there's a couple other connotations attached to it. So the fact that, Bitcoin's permissionless, you don't need permission to join or leave the network. But it's not always as decentralized as we think. There's a lot of dependency placed on developer groups who actually decide on the future of the protocol, and we've seen this happen in Bitcoin, where the protocol developers have changed the rules of the game multiple times. And so there is an element of centralization still within the system where developers are deciding on the future of a coin based on, what they want. So yes, it is decentralized, but just pointing out the fact that there is an element of centralization as well.
Okay, that makes sense. Now, the last word I'm going to ask you is crypto wallet. What is a crypto wallet?
So a crypto wallet is really the first thing a user needs to be able to interact with a blockchain. All blockchain transactions are ultimately payments. So if I send money to you, I need to have an interface or mechanism with which to do that, and that is what a wallet is for. And how that works is you'll have an address that you'll give to me, and then I'll send coins to that address. And that kind of leads me into wanting to talk a bit about private and public keys, which is a bit confusing, but so in crypto, let's say I want to create my own wallet with my own address, and I don't want you to see my password, right? Because then you'll be able to steal my money. So I'll create a password in secret, which is my private key. Then I'll apply, the Bitcoin network does this for you, but you'll then take that number and convert it into a public key, which I can then give to you that you can pay money to. So now I've got money in my wallet, but I can only move that money somewhere else again with the private password that I've got to kind of unlock that money. And that is, if I keep the password myself, this is where we get what's called non-custodial wallets, which means I'm the custodian of my own money. I've got my own password, but I'm also required to keep it safe. If I lose that password, then I lose my coins forever. And people have started providing a service called a custodial wallet, and this is, most of the bigger companies provide that service where you log in onto an online platform, and then your coins are there, and you can move them, but you're not required to use that private key. That business does that for you. So we've kind of got these two worlds, a custodial world where someone else manages the keys for you, or you can choose to manage the keys yourself. But what we see is when people try and manage their keys themselves, it's probably more secure for them, but people often lose their keys, they lose their wallets, and then they lose their money, which is a pretty bad experience to have. So most people probably would prefer a custodial wallet, but it's really a personal preference and depends on how much you understand. And it really comes down to playing with Bitcoin. I would suggest everybody just gets a little bit, move it around, see how it works, and then it's not so scary anymore because it's actually not that difficult to use.
So hold up, you said if I lose my key, I lose all my crypto.
Mm-hmm.
That's really scary. So if I'm really scared about that, do I have another option? The custodian wallet you mentioned. So how do I, as a retail investor, how do I get into something like that?
Yeah, so I mean the EC10, EasyCrypto 10 bundle that we offer is custodial. Okay. So you log into EasyEquities wallet, and you buy the EC10, and it stays there. You're not required to then go put in a safe and write on paper, your coins. So we provide that service. There's obviously other places where you can buy Bitcoin in the country where you don't have to worry about that. Mm-hmm. But yeah, we offer that service, and we obviously secure the crypto in highly secure vaults. We use best-in-class companies like BitGo, which is an American registered custodian to store the coins on our behalf. So yeah, it's safe.
Okay, that's good to know. And you mentioned at the beginning of this chat that you invested in the EC10 yourself because you want that peace of mind. You don't want to know which crypto's at the top of the list each time. So how much of your portfolio is basically the percentage is crypto?
At the moment, it's about 50%. Okay. Used to be 100%. I'm obviously slightly younger and have a high risk tolerance. And when I found out about Bitcoin about in 2015, 2016, I started investing. I just went like all in, which in hindsight was probably not the smartest thing to do. But yeah, I like crypto, I understand it. And so for me and my personal risk tolerance and preference, I like to keep a bit more in there. Everybody has obviously got to do their own thing that makes sense for them.
Okay, so I'm going to put you on the spot here. I know a few of our investors that are watching this conference might not know exactly where to find the EasyCrypto 10 bundle. So, Rob, where do you find the bundle on the platform?
So on your EasyEquities wallet, in your ZAR wallet, you can find it on there. It's under the crypto banner, or you can just search for it and you'll find it on the platform. And on the first week of March, hopefully we're launching the EasyCrypto wallet separately on the platform. So just as you have your EasyEquities ZAR and Easy Properties wallet, you'll also have EasyCrypto. And we're planning on expanding the offering, adding individual coins like Bitcoin and Ethereum, and also unlocking the platform to be like more 24/7. The trading hours, so yeah, there's a lot to be excited about, and yeah, watch the space.
That is some really big changes. So guys, you heard it there first. There's the T. EasyEquities is adding its own wallet, and plus they're adding individual coins. So be the first to tweet about that. Remember, when you tweet about anything about the conference, you stand a chance to win 5 big ones, okay? So tweet about that. Okay, just to bring it back before I get the next speaker here. Rob, you said you've got 50% of your portfolio in EasyCrypto, right? And if I was a newbie investor and I wanted to invest in this bundle, how will I get charged? What are the fees entailed to this bundle?
Sure, so like everything on EasyEquities, we only charge a 25 basis points or a 0.25% brokerage fee, so if you buy or sell. And then there's a 2% fee charged annually, so on a monthly basis it's obviously, smaller, but that is for the management of the EC10 bundle. Obviously, the company has to switch out coins from the top 10 and manage the infrastructure, so that is kind of a fee over and above the trading fee.
Okay. And you mentioned there's a board fee there. So is that board in charge of choosing the top 10 cryptos inside the crypto bundle?
No, so that fee is purely to maintain the infrastructure. So when the coins come into the top 10, the market capitalization really determines which ones are in the top 10, and that is how we decide which ones make it into the top 10. So there's not much decision making there, the market decides for us.
Okay, all right, sweet. Okay, and I'll ask you a personal question before we head off here. Rob, when did you get so invested in this crypto space and world?
Yeah, so I found out about Bitcoin in 2015 and then started making investments, and then I managed to make some good returns, and then we went into, at the end of 2017, like a bear market, and lost a bunch of money again. But yeah, I've just really engrossed myself in the space. I previously, before I joined Purple Group, worked for a wallet company for about 2 years, where we built out cross-border remittance products using Bitcoin, as well as a wallet. So yeah, that's where I got a lot of my kind of more in-depth experience and knowledge about how Bitcoin works. And yeah, these days I'm obviously working for Purple Group and involved in the EasyCrypto business. So yeah, that business keeps me on my toes. But yeah, it's excited for the next few years.
Awesome. So guys, if you really love the EC10 crypto bundle and you want to find out more, head over to our blog portal. Everything is there about the bundle. And you can also head to easycrypto.co.za where you can find out more about the bundle as well, and EasyCrypto, the company itself. And that brings us to the end of my conversation with Rob. Rob, thank you so much for joining us. And up next, we'll have a really good award-winning author. Stay tuned.
Thanks.
So up next, we have an award-winning author, Stephen Boyke Sidley, the author of Beyond Bitcoin, Decentralized Finance, and the End of Banks. And that's the book, guys. I'm going to jump off stage and let Stephen do his thing, and all the best.
Thank you very much.
Sweet.
We'll see you in a few minutes.
Cool.
Right. I've been Right, I've been told that I have about 15 minutes to try and cover what I wrote in this book, and I decided not to do it as a presentation, but rather as a talk. So I'm going to speed through the contents of this book, and I'm hoping that by the end of my little introduction, you'll have a good feel for this thing called decentralized, commonly known as DeFi. Beyond Bitcoin, Decentralized Finance, and the End of Banks. And I just want going to disappear, but they're going to will disappear. So it's a metaphorical statement, and it made for a sexy piece of the title anyway. Before I talk about what DeFi is, I'm just going to give a little genesis of how this happened. At the beginning of 2021, we're in the midst of lockdown. It's depressing. I'm looking for something to keep me from going crazy, and I phone Simon Dingle, who's been in crypto since the beginning, and I've been in crypto since 2017, and I said, let's write a book. The reason we wanted to write a book at that time, other than being in lockdown and having lots of free time, is that it had become evident by 2020 that something else was bubbling under the crypto ecosystem. Everybody knew about Bitcoin. It dominated the headlines. But there was something that had started to happen called decentralized finance. And we decided to write a book on, we did a little non-scientific poll at the time. We went out to a bunch of bankers and we said, have you heard of DeFi? And all of them said, no, they've never heard of DeFi. By middle 2021, all bankers had heard of DeFi. By this month, every single bank in the world has got DeFi initiatives. This is a transformative technology, perhaps more transformative than Bitcoin and other currencies earlier. So, to rewind, 2009, a pseudonymous programmer by the name of Satoshi writes a white paper, which is the famous Bitcoin white paper, in which he solves the multiple problems that researchers had been battling with since the early 70s to build digital money. There were multiple problems: trustworthiness, non-counterfeitability, unmalleability. There were a whole bunch of them, and in one single fell swoop, he wrote this paper, 9 pages long, and solved it all. And Bitcoin, as we know, began with the sale of a pizza for 10,000 Bitcoins, still celebrated as Pizza Day. And that's when it first got its value. But something more important happened in 2014. In 2014, a skinny, very skinny, Russian-Canadian teenager by the name of Vitalik Buterin thought he had a better idea. What he did is he built a Bitcoin-like set of plumbing and architecture and technology. He called it Ethereum. But on top of that, critically, he put a layer which was a programming language. And the programming language was like any other programming language, and the programs he called smart contracts, and he presents to the world and says, dream up your own application. Compared to Bitcoin, which was basically a store of value application or a money application, he said, there's a programming language here, do your worst. And a bunch of developers, many of them very young people sitting in garages, started looking around at this programming language and looking around in the world as to what they could apply it to, using all the wonderful stuff that blockchain could do. And they saw targets on the backs of the financial institutions. And they said, geez, I don't like my bank, and they don't answer my calls, and I think they're charging me too much for loans, and they're not charging me enough for deposits, and I get these transaction fees which I don't understand. I'm going to go after the banks. I'm going to go after the insurance companies. I'm going to go after the stock exchanges. I'm going to go after the derivative markets. And they started developing these applications. DeFi is a set of applications which the financial services that we are familiar with, and produces a set of these services which are 4 things: faster, more trustworthy. Today, I can go to a URL, open up one of these projects, and put money in and earn myself 13% at extremely low risk with no exposure to the volatility of the cryptocurrency prices. Banks simply cannot compete with that. If you live in the United Kingdom, you live in the United States, you get less than 1% in your current account. For those people, if they have something at 13% that they can do in a few seconds, the banks can't compete with that. So 2020, this thing exploded in our faces. By 2021, everybody had sat up and took notice, and particularly the banks and the financial institutions who said to themselves, or in fact said publicly, this is kryptonite, this is rat poison, this is not serious, this thing's going to collapse. All of them have changed tune and have come on board and tried to find a way to make these DeFi initiatives work for them, which is the next stage. More importantly, those developers who reimagined and rewrote those financial institution services that we all know and maybe don't love so much, there were a bunch of new applications that were written that can't be duplicated in the traditional finance world. I heard of an absolutely lovely one yesterday in which you can take a tiny little piece of your house, 1% of your house because you need some money, sell that 1% as an NFT. Now you've got 10,000 Rand because your house maybe is worth R1 million, which you can use for whatever purposes you want. The buyer of the NFT doesn't want residents in the house. He bought that NFT because he sees the house appreciating over time. And he may flip it to somebody else and may flip it to somebody else. Meanwhile, you've got the money, you don't have to pay it back, there's no term in it, you don't get to lose your house. There are a whole wild set of new applications that have been dreamt up under this genre called decentralized finance, which is not possible in the traditional finance world. I'm just going to end by talking about some of the headwinds that are faced by DeFi. Biggest headwind at all are regulatory headwinds. I need the production staff to tell me when I'm getting near my 15 minutes, okay? The regulatory headwinds, the people who have the most to lose from this technology are, number one, the commercial banks and the insurance companies and the exchanges, and number two, the nation state, because underlying this is a separate currency, a parallel currency. And you'll see a wide spread of regulations now being implemented all the way from the worst, which is China, which have basically said to the citizenry, if you even mention the word cryptocurrency or Bitcoin, we're going to throw you in jail for the rest of your life, all the way to a country like El Salvador, which has mandated that Bitcoin is legal tender. In the center of that pile, you've got all the other states. There is no global standard. So they are wrestling with, how do we stop people from cheating on their taxes? How do we get through sight as to what's happening in DeFi so that we know when to raise interest rates or we know when to inject liquidity into the economy? The headwind is not so much that the regulation will be onerous. The headwind is that regulation moves at the speed of regulation, which is years and sometimes decades, and technology moves at the speed of the internet. And that's where the friction lies. The other headwind is crime, hackery, financiering, grifters, scammers. That stuff happens all the time, but you have to keep this in perspective. In the 13 years of crypto, $35 billion has been stolen or lost or hacked. There is $1 trillion a year that is stolen in the traditional world of finance. It turns out that because the blockchain is transparent and open, people leave breadcrumbs and they do get caught. The traditional world is a much lower hanging fruit for criminals. And the crime part of crypto has been overplayed by the newspapers because it is so sexy, but it is just a tiny pimple compared to the amount of crime that we know about in the traditional world. Finally, what does this herald for the future? The future of DeFi, one needs to remember that the history of modern financial institutions started in about 1100, 1200 with the Medicis in Italy with the first modern banks. So it's been around for, what, 1,200 years. This stuff has been around for 3 years. So this is a squealing, yelling, spitting, drooling baby compared to the ossified and slow-moving world of traditional finance. It has just started. It is already producing products that the banks and the insurance companies and the traditional financial institutions cannot compete with. And so we are to see some fantastic new products. And those fantastic new products make it fairer for the rest of us and more difficult for those who hold financial power.
Guys, I'm back with Stephen and Rob. I have to say, I was just reading a tweet on Twitter. Someone said, I was today years old when I learned X, Y, and Z. And I've got to tell you, Stephen, I was today years old when I learned pretty much everything you've just said.
Thank you.
Super interesting. Tell us a bit more about your book.
Okay, so first of all, I want to tell people who the book is written for. The book is written not for techies. The book is written for the intellectually curious person who perhaps invests in cryptocurrencies through EasyEquity, or is just interested in Bitcoin and doesn't fully understand it, and maybe reads an occasional blog. The book is written to give an accessible and sometimes funny introduction to this world. By the time you finish this book, I guarantee there's no jargon in this book that is not fully explained. You will understand the entire DeFi landscape. Secondly, where can you get this book? I'll get killed by my publisher if I don't talk about that, so give me 2 seconds to do that. This book has been published internationally on 5 continents in the last 3 weeks. For South African investors, it is in every store in South Africa as of last week, plus Amazon, Loot, Take-A-Lot, and all the other online outlets.
Nice. I want to know, were you this famous when you were playing in a band?
I was much less famous, but I was much younger and cuter.
Nice. So tell me, how did you actually find your way into this industry, Stephen?
I have a Master of Science from UCLA in computer science. I've been one foot in technology all my life, and then I got married in 1995 to a writer, and it looked like a hell of a lot of fun. So I started writing novels in 2011, and I've written 5 novels for Picador in South Africa and for Melinda Ferguson Books, and then decided to take the leap into nonfiction. I was unaware of the fact that when you write a novel, you sit down and you make up stuff, which is much easier than sit down and having to get it exactly right.
Because then it's out there for the whole world
Out
to
there,
see.
yeah, you don't want to embarrass yourself.
Yeah.
So it took a lot of research. By the way, this book, my co-writer's name is Simon Dingle. He was my technical resource to make sure I didn't stray too far off accuracy and precision.
And what excites you about this industry today? I mean, you spoke so passionately just now, but if you could sum up, what's exciting to you?
The world of finance and investing and money, since again, the Medici Bank, even if you go back 6,000 years, well before then, has been one of asymmetry. It's been a world in which the financially powerful set the rules. I'll give you a simple example. If you get a statement from your bank at the end of the month and they say, this is New Year, we're going to raise transaction fees from X to X. And you say, I don't like that, that's too much. Why are they raising transaction fees? You call your bank and say, please explain to me why you're raising the transaction fees. Please show me the Excel spreadsheet in which you rationalize the increase in prices. I want to know the cost base of the price increase. They're going to tell you to go take a hike. Similarly, if you ask why your premiums are what they are in insurance companies, similarly, if you ask why you're paying so much in commissions at your stock brokerage, similarly, if you ask why the loan amount that they're charging you to get your house is so high, they don't give out that information. They are a black box. They don't have to tell you, and they'll tell you to go take a hike, which you cannot do. Why can't you go take a hike? Because to close your bank account down and cancel all your credit cards and cancel your mortgage and move from this bank to this bank is impossible. It's a pain in the neck. There's too much friction. The bank and the financial institutions are the ones with the financial powers, and we have to take what we can get. DeFi flattens all of that. Give you another fantastic example of this. If you have 200 Rand to open a bank account versus if you have 200 million Rand to open a bank account, who gets their calls returned? Who gets taken for dinner? Who gets invited
Not
to
me.
Arabella? Not the 200 Rand one. In fact, the person with 200 Rand probably can't even do it because there's a minimum of 1,000. We don't even think about that, but it's not fair. It's not democratized. And it excludes people and it rewards people who already have money. DeFi breaks that all down. If you put 200 Rand into one of the DeFi protocols or 200 million Rand, you get treated exactly the same way. There is no preference. So we are tremendously passionate about DeFi as a financial inclusion technology, specifically for a country like South Africa where so many people are excluded.
Yeah, definitely. Rob, I can see you nodding your head there. Damn the man, this is making me very excited. Like, down with the big bad, I don't want to say big bad banks, but the system that isn't working or serving us properly.
Before we slam the banks too badly, they're working within a system. They're not evil people. Some of my best friends are bankers. These people are doing a great job with the tools that they have. The problem with the tools is that they're slow moving. There is governance, there is compliance, there is committees, things, it takes years, perhaps decades to do new product. Not specifically their fault, because they have not glommed onto this technology yet. They will have to.
Yeah. Rob, what do you think about DeFi? What are your thoughts?
Yeah, I mean, one of the most exciting things for me is the global nature of it. You know, the fact that a Bitcoin in South Africa is the same as a Bitcoin anywhere in the world, and that, you know, it's so easy for people to stay in touch with their families. You know, it's just got so many applications from a retail and a business perspective. The fact that people can send money to family members anywhere in the world instantly with very little fees, and then the same for business. And I think, you know, we're so early on in this journey that there's still so much to be built and developed. It's a very fast changing environment, and I think we're very early. It's just crazy. One of the things that really excites me at the moment is play-to-earn gaming. Especially in poorer countries, you know, people are now able to play computer games and like earn a couple dollars a day. And yeah, it's fun, and that's just one of the cool things that I see happening that's changing the game in business. It's kind of taking NFTs and Bitcoin and payments and combining all of it into a pretty cool application.
Yeah, it's a very exciting space.
Let me try and just quickly differentiate for some of the people who are watching something that may not be clear. The world of cryptocurrencies, when you're investing in cryptocurrencies, whether it be Bitcoin or Ethereum or some of the others that you mentioned, Rob, what you are looking for is the price of that currency to rise so that your investment appreciates. Okay? Straightforward stuff. DeFi is slightly different. Most of the DeFi initiatives, you're looking for a percentage yield every year. So right now, as I mentioned earlier, you get whatever you get in your savings deposit or your checking deposit, but there are a multitude of DeFi initiatives where you can get 13%, 21%, over 50%, which I got on an account in which I just had money sitting. So it's not a price appreciation play, it's a return on investment play.
Okay, yeah, that's a good differentiation. Tell me, Stephen, you know, we're all so accustomed to have grown up with our whole lives kind of the traditional financial services systems and banks. You know, there's this feeling of trust, there's this perception that my money is safe and secure, these are well-established, you know, organizations. How do you feel people are going to start acclimatizing to this new way of doing things? How are they going to find that comfort with this new technology?
When I talked about the headwinds earlier, I didn't mention this one because I was running out of time, so I'm going to answer that in two ways. The matter of trust is absolutely central to this business, and you trust your bank, and you have good reason to trust your bank. They're not going to lose your money. They're going to do what they say. They are insured. They do comply to government laws. They are trustworthy. They charge you for that trust. You pay fees in order to get that trust. They have long-standing brands. You pay for all of that. They have big marble buildings. They have executive perks. They have shareholder profits which they have to distribute. But you still trust them. And our contention says that's all good, but you're paying too much for that trust. Now, on to the second part of your question. How do you trust these DeFi initiatives? Are they less trustworthy? Because the DeFi initiatives are codified within a smart contract, which is a computer program which is open for everybody to see and audit, they are in fact more trustworthy. Why are they more trustworthy? Because when you have human beings, that's where the trust problem comes in. All of the hacks that have happened in banks is because somebody inside the bank was a bad actor. Human beings are less trustworthy than math. Math is just math. 2 + 2 = 4 does not require trust. But there is a subtext to your question. The subtext to your question is, what is going to cause the average investor to say, I'm going to put my money in here? And that is where the gap occurs right now, a gap that I'm hoping that EasyCrypto will fill, in which you have an intermediary that you trust, like EasyCrypto, and they say, we will front end for you this big DeFi complex machine of mathematics. Right now, if you go into one of the DeFi initiatives, it's utterly terrifying, even for somebody like me who's been around for this thing. So there is a custom interface, a customer service, a user experience gap between investors and DeFi. Right now, the only people investing in DeFi are the people who have big cojones.
Well, if there's anyone that can easyfy things, I'd like to think it's us. Rob, it just got me thinking when I was listening to Stephen speak earlier, and he was giving the example of putting a piece of your house up as an NFT and kind of being able to sell that and have the next person flip it. And it made me think of our Easy Properties. Do you think that's something that businesses and our business could start implementing in the future as a different way of working?
Yeah, I mean, we've had discussions internally about how we could, create NFTs in our environment. It's kind of, been put on ice for the moment, but certainly in future, as the space evolves and, we can come up with interesting ways to incorporate more of these fun things in the business. We like keeping things fun and easy, and I think, that's certainly something that can spice things up for our users. So, yeah.
So you heard it first, guys. Watch the space. Stephen, do we think that this will be the end of banks eventually, or are they here to stay and they're going to have to innovate?
The latter, absolutely, not the end of banks. Financial institutions important. As Rob mentioned earlier, the decentralization is very, very important in some respects. For instance, in trustworthiness, you have thousands of anonymous people all having, or anonymous computers all looking at the same transaction, and they all say it's good, then you know it's good. But centralization has its role in life as well. And when I talked about earlier, the necessity for customer experience user mediation in the center between the retail investor who doesn't want to learn all the stuff, he just wants to get the best return on his money, and this big complex system requires a person in the middle, and that could be you guys, it could be financial institutions, but if they don't change the way, if they don't incorporate this technology and throw out those massive data centers and thousands of programmers, those won't survive.
Okay. So let me ask the both of you in closing. It's 2022. What kind of progress do you think we'll get on DeFi this year? Do you think we'll get something this year? Do you think it'll only be in years to come? How soon is this to our lives?
It's here now, as I said, for the sophisticated investor, but most important, one of the biggest lend-borrow DeFi initiatives is a company called Aave, A-A-V-E. And they saw this gap, and while they have a very high-yielding product called Aave, where you get very high rates of return, only sophisticated investors or ones who are courageous were going into it. They built an institutional version of this. I can't remember what it's called. It's called Pro Aave something. Specifically for sales to financial institutions, and it's being snapped up by banks all over the world. So you will see the stuff start appearing in all banks and financial institutions in the world. Most of them are already kind of sticking their toe in the water gingerly. The first one to offer a service like the Aave service, the others will all follow. I think you'll see an explosion of this in the next 12 months.
And you, Rob, anything to add?
Yeah, I think, from an institutional perspective, your primary, concern is protecting your customers' money. And I think it's going to take time for businesses to see the trust. I mean, there have been failures in some of the DeFi protocols. They have got hacked from time to time. They do go through thorough security audits, but yeah, I think businesses would like to see at least a certain amount of time, like we have with Bitcoin, where it proves itself as being safe, and the safe protocols will surely have good take-up. So I think you'll start to see that. Maybe not this year necessarily for all businesses. There will be some doing it, and there are some doing it, but I think next year we'll probably see that accelerate a lot more.
All right, awesome. Thanks, guys. Right, guys, we got someone who's very familiar with the EasyEquities community coming up. His name is Stefano Marati. He's the CEO of Renogen, which is a helium miner. Now, if you know Renogen, you'll know that its share price has gone up by 192% in the last year. That's crazy. And what's really exciting is this company is actually looking at tokenizing the gas. So you'll be able to purchase virtual tokens via an exchange. And guess who's doing the platform and the tech behind those things? It's EasyEquities and EasyCrypto. So very exciting. Now, Stefano's a busy guy, but he always makes time for the EasyEquities community. I'm sure you guys have seen on social media, he's taken a whole bunch of people to go to the actual Renogen plant and see the magic that happens there. But unfortunately, he couldn't be here for us today, but he has sent a video. So we're going to play that video for you now, and we'll pick up again with the conference just afterwards.
That I am not a person, but with kids, and I'm going to be at a swimming pool, so I agreed to record this beforehand. If you do have any questions in terms of what I say, by all means, reach out to Carl or the guys at Easy, and you can forward the questions on. Alternatively, I'm on Twitter, or you can find my email quite easily. So feel free to reach out. And the topic of the day is obviously the use of crypto as a new asset class in business. And I think this is a great topic. The one thing that we certainly learned when we came out the blocks with the ARGI tokens is that crypto definitely has a place, and increasingly, certainly our vision is that in probably 12 to 18 months from now, it'll be a very difficult decision for a company, especially junior mining companies such as ours. It'll be a difficult decision as to whether you're going to list on a traditional stock exchange or whether you go the decentralized route using crypto. And there are some spectacular advantages to the blockchain market using tokens as opposed to using the traditional listed equity space. So I suppose with that intro, I'll tell you a little bit about what it is that we did, how we went about doing it, and where I see the advantages, certainly the advantages from Renogen's perspective, and then elaborate on some other deals that I've also heard about, which are also really innovative. So if you look at what we did, first and foremost, it's not Renogen issuing the tokens. There's actually an intermediary. There's another company called Argonon, which is a foreign company domiciled outside of South Africa, and our main producing asset, Tetra 4, our subsidiary, entered into a helium offtake agreement with Argonon, the intention of which is that Tetra 4 has given Argonon the ability to procure helium at a significant discount to what the spot market is, and in order to raise the financing for Argonon to be able to pay for these tokens, for the helium, Argonon has gone off into the market and it's issued tokens. Now this is where the smart people at EasyCrypto came in, and Don and Earl and co got together, and they put together all of the infrastructure in the back using the BEP20 platform, which I had no idea what the hell it was until we got into eyeballs deep into all of this stuff. But I'm sure that everyone on this call is a lot smarter than me and actually knows what the hell I just said. But they put that platform together for us, which then allows us to be able to have these tokens issued out and traded and transferred between wallets and then eventually put onto exchanges. The key behind the transaction obviously being that now Argonon, through the issuance of these tokens, raises the cash that it has the ability to then prepay for this helium. And when our plant is operational, along will come the time when end helium users who are looking for spot helium will be able to go out onto one of these exchanges. They'll be able to buy tokens, and depending on what the helium requirements are, they'll buy a certain number of tokens. They will send those tokens to Argonon. Argonon then in return agrees with us a delivery schedule, much the same way that the helium market normally trades. So the buyer and the seller agree as to when the ship is going to arrive, when the trailer is going to come up to the plant, how we're going to fill the trailer, and how we're going to send it back. And once that's been agreed, then Argonon burns those tokens, and we issue a delivery certificate, and that delivery certificate that delivery notice or certificate goes to the end customer. When the trailer arrives, they give us the certificate back, we give them the helium, and the transaction is complete. So from that perspective, all that we've done over here is that we've used an electronic ledger to really keep track of the transaction in much the same way that an absolutely bog standard helium spot sale would have taken place. Obviously, the one major advantage over here from Renogen's perspective is that we have used this mechanism. We've extended it one step further in that we've pre-sold the commodity now for a future delivery date, whereas in the spot market you'd pay instantaneously. And the benefit that the end user gets for this is that we're issuing the tokens as it stands right now. We went through around at $235 per MCF, and MCF is a unit of helium, so much the same way an ounce of gold or an ounce of platinum. Helium trades in MCFs. So 1 MCF of helium, we started selling 1 MCF at $235, then $250, then now $275. But the spot market is between $1,100 and $1,300 per MCF. So the rationale for anyone coming into this space, what's their upside for prepaying on this, and the upside for them is the fact that this is this helium is particularly cheap, and retail investors would never otherwise have been able to get into this market. So that's in essence the mechanism behind what it is that we've done and why we've gone about it. Well, I suppose the why is also it's raising the cash, but more importantly, from a corporate perspective, we are, in a nutshell, securitizing an asset underground, and it means that we're raising capital without diluting shareholders, and dilution is obviously key. The less that you dilute means the more that the current existing shareholders retain ownership of the underlying project. And so from that perspective, it's a win-win all around. So then the question is, if everyone wins, who loses? And the simple answer to that is basically the middlemen in the helium market in our instance. So the helium market is quite a quirky market. There are 6 companies that act as middlemen. These middlemen literally buy helium from the upstream producers at around $250 to $300 per MCF. They're selling it between $1,100 and $1,300. Their total all-in cost for moving the helium is less than $80 per MCF, and they keep all of the margin without taking any of the risk. And the way that these 6 companies control this cartel is by virtue of the fact that they have a bunch of trailers, and no one else has these trailers. From our perspective, the big difference is that we've actually managed to order a bunch of these trailers ourselves. So by the time that our project comes online, we will actually be the 7th participant in that market. And yeah, we managed to get it through the goalie that we've managed to get a hold of these trailers. So watch the space now with our own fleet of trailers and access to the upstream and the taps. We become the only one of the 7 traders that has both the trailers and simultaneously access to the taps itself. The other 6 are literally just traders. So so in essence, you know, to coin the phrase that the easy guys keep using is the whole democratization process, and we see this as a means of democratizing the helium market to the benefit of the rest of the world. So yes, there is a loser. Fortunately, the loser is definitely not us or the token investors, which is good. So that's the why part, and the when part, and I suppose the how part covered. How did we cotton onto this idea? And the rationale was simple. I mean, there's always been a lot of talk about why blockchain is important, and if you think about blockchain at its very most simplistic level, all that it is just a timestamp database, and it's obviously protected by cryptography. The important thing over here for us was that this becomes a digital way to use other people's computing power to simplify the transaction process between what we do in terms of delivering a product and the customer taking custody of the product that we produced. And that's where a lot of people saw the long-term trajectory of where blockchain would eventually go and where cryptography would go. Unfortunately, the rules around crypto are particularly complex, and every regulator has its own take on what needs to happen. And as a result, it's become very difficult for the average Joe or the average company to go out and issue its own crypto. Point in case, it took us about a year to navigate the regulations until we came up with the ARGI, and the ARGI is, I mean, on the face of it, it looks pretty simple, but what's going on behind the scenes is incredibly sophisticated. Now that we've done it, now we've got a cookie cutting machine that can literally, we can replicate this and do this for absolutely any commodity. But getting to that point in the first place was an incredibly difficult task. And I think that's probably been one of the biggest challenges in terms of the adoption of crypto for many other asset classes. It's not to say that it hasn't been done, it's just that there have been limitations. There is, on our discovery of how to get things done and trying to learn from other people so that we weren't reinventing the wheel, we came across some other pretty clever assets, and the one asset that we did see, and was just absolutely bloody genius. There is a, if I get the story right and you can think about it, there's a meat producing entity in Southeast Asia, and they pride themselves on the fact that the meat is organic and free range and this and that and the next thing, and basically all of that good stuff in terms of what we want to make sure we're putting into our bodies, in terms of being health conscious. And what these guys did was that they created an entire blockchain methodology around every single cut from the animal. So the animal comes in, and that animal is governed by a token. And the animal comes into the abattoir, it's slaughtered, and when it gets slaughtered, every single cut from that animal is then packaged, and that new package of meat is then linked to the original token with its own token. And then that goes from butchery to butchery. And at the end of the day, the ultimate customer will walk into a supermarket, and then with an app on your phone, you can take a picture of a QR code, and it gives you the exact timeline, step by step, of what happened in this animal's life from the time that it entered the abattoir to the time that it ended up on your grocery shelf. So you've got a complete chain in which you can validate the path that this piece of meat went onto. And that becomes an incredibly powerful tool. Now it's obviously been quite an expensive thing for them to implement because they were the first ones to do this. But again, once you've set it up and you've got the thing working, there's no reason that 5, 10, 15 years from now that absolutely everything on every single supermarket shelf doesn't follow the exact same chain, auditable chain. And I think that that's going to bring a whole new dimension to accountability, transparency. It's going to bring all sorts of advantages in terms of making sure that everything is where it is, and it does what it does what it says on the tin. So from that perspective, I can see that that the future is definitely in the space. So then the natural question that you ask yourself is that if this is the future and that this is where everyone is working towards, why is there such resistance? And you have to think about who the people are that are putting up the resistance. It's primarily people who don't want to be done out of a job. So your traditional stock exchanges are pretty hesitant. The JSE has been quite adoptive, but there are some other exchanges overseas that are very resistant towards crypto and blockchain. And that's because these companies have huge cost bases, and they need to charge exorbitant fees, and listing on a foreign exchange is a very, very expensive process, whereas getting crypto up and running is probably less than a quarter of the legal fees of a listing on a main exchange, and chances are you'll actually be a lot more successful launching onto one of these crypto exchanges. So I think it's a very real threat to a lot of these companies, and on the basis that it's such a big threat to many of these companies moving forward, they're the ones that have been lobbying hardest to try and make sure that none of this gets up and running. And obviously they're lobbying to their securities exchanges, and so you've got many barriers to entry, and you've got this enormous moat that these companies are trying to put up around themselves to stop crypto from taking off. So I think in summary, what I'm trying to say is that whilst the technology is amazing and it's got lots of applicability, I think probably one of the biggest inhibitors towards its wide-scale adoption in business at a very rapid pace has been preservation of the status quo, the inefficient status quo that really takes creates a lot of friction costs into the system. So in our small part, I think my 15 minutes is almost up. I've got a timer over here telling me that I'm done. I think the parting shot that I would leave is I'm particularly optimistic about this space. I think this is really going to revolutionize the way that we do things. I can see it as the future. My mantra, and everyone at Renogen, you know, we keep repeating this in almost every single meeting that we have. Our firm philosophy is that if you are not disrupting, then prepare to be disrupted. And I think we need to adopt that in practically everything that we do in life. So I've overextended my welcome. I would like to thank you all for the opportunity to talk. Pity I couldn't do it in person, but you would have had a whole bunch of screaming kiddies in the background had this been live. If you've got questions, feel free to reach out, either through Carl or Earl or Don or the team. They've all got my details if you don't have my details already. I'm on Twitter. Reach out, and yes, thank you very much for the opportunity. Watch the space. I think the Argies are going to tear it up, and yeah, looking forward to many successful rodeos in the future with the EasyCrypto team. Thanks a lot, guys. Ciao.
Welcome back, guys. That was a great chat from Stefano. Thank you so much, Steph.
Yeah, it was a great chat. Like you said, watch the space. They are doing crazy things with the EasyCrypto team. And are you invested in Renogen, Carly?
Funny story.
Okay.
So did you see the tweet I posted yesterday about spending way too much money on takeout?
Okay.
Right, so this month, I got paid yesterday. This month, before I have the chance to spend money on junk food, I thought I'm going to buy shares. And those are the shares I bought Renogen with my takeout money for this month so that I don't spend
Welcome
it.
to the party. A bit
Thank
too late,
you.
but we are riding the wave. Don't worry about it.
I'm in it for long term, okay? That's how I roll.
That's the way we roll as well at EasyEquities, long-term investing. So guys, up next, we've got Don Kruger, who is the product development lead at EasyCrypto, and he's actually front-running the new platform itself. Did you know that?
Do we get a sneak peek? Or...
No, don't worry, I got you on Monday.
Okay, nice.
So Don's not going to show you a sneak peek of the platform. I hope he does, but if he doesn't, stay tuned because we will post about it everywhere. So up next, we've got Don Kruger.
Hi everyone, my name is Don Kruger and I am the product development lead at EasyCrypto. So just a bit of a background about myself. I completed my honors in investment management at the University of Pretoria, and then I completed my master's dissertation with a specific focus on the investment implications of cryptocurrencies or crypto assets in South African investment portfolios. Now, it was easy and interesting actually to see how in my first year of study, cryptocurrencies went from being sort of a taboo area of finance, how in my 6th year of study, that they had become a topical area of research in academia. And that's why I'm excited today to present to you the following. What I'm going to do is briefly challenge traditional notions of risk and value in finance, specifically look at the role of utility in value, and then look at some of the contemporary valuation models circulating around industry at the moment. Now, one of the first things that people may think, or they may tell you, if cryptocurrencies or crypto assets come up in conversation, is that it is a risky asset. And if you ask them why it is risky, 9 out of 10 people will tell you because it is volatile, volatility of price, right? Now, volatility of price is actually one of the more misunderstood notions of risk in finance. And I think a great way to understand why is by looking at what is called the Sharpe ratio. So the Sharpe ratio was created by William Sharpe in 1966. He subsequently won a Nobel Prize. But what I'm going to do is I'm going to challenge this Sharpe ratio. I'm going to be blunt about the Sharpe ratio. So basically what the ratio describes is excess return per unit of risk. So basically the formula describes your investment or portfolio return less the risk-free rate of return, let's say on a government bond, divided by a unit of risk as measured by standard deviation of price. Now, using standard deviation of price has since become a widely accepted notion of risk in much of academia and much of finance. But we have to dig a little bit deeper when we simply say that this volatility of price is a proxy for risk. And let me explain why. Let's say we have our investment portfolio. We have upwards and we have downwards movements happening, right? And this volatility, this dispersion around the mean, we refer to as standard deviation of price. But the truth of the matter is, if you have a lot of upside volatility, which is shown by the green arrows on the chart, you're doing well. Your portfolio is booming. So that is a desirable event. It's a desirable type or aspect of that volatility. And that's why it's actually more accurate to isolate the red arrows only, the downside movements only. And we refer to this as downside risk or downside deviation. All right? Now, there's since been an improved version of the Sharpe ratio that specifically looks at true risk, which is your downside risk. And we can see this in what is called the Sortino ratio on the right-hand side. So what I did here is we plugged the Sortino ratio into the EC10's historical data, and what we can actually see is a superior excess return per unit of risk, which is the value here on the right-hand side, 21.22, versus the antiquated proxy for risk, which is volatility on the left-hand side. So now we've learned something, right? We've learned that it's simply not enough to say that volatility of price is a proxy for risk. But what if I told you that crypto assets can actually be used to mitigate, reduce your portfolio risk? Let's say now we are holding two cryptocurrencies, just theoretically, in equal weighting. Crypto asset A, represented by the red line, and crypto asset B, represented by the purple line. Now, if we are holding both of these and their prices are moving in opposite directions, well, then we are offsetting that risk. We are offsetting that downside volatility and aggregating the return to this dashed green line. Now, this is basically, in a nutshell, the premise of portfolio diversification, and it is a risk mitigation tactic. So essentially, this is what is happening inside the EC10 cryptocurrency bundle. Now, it is worth noting that the 10 cryptocurrencies in the bundle, they are highly correlated because the sector does correlate. But there is nevertheless some extent of portfolio diversification in the bundle itself, and thus some extent of risk mitigation. What if we were to zoom out? So what we do here is we can actually look at the EC10 in the context of South African markets. And we can see that the EC10 can also enhance portfolio diversification against exchange-traded funds. So here we've actually plotted the EC10 against the Satrix ETF funds accessible on the EasyEquities platform. The green areas show enhanced level of diversification, and the red areas actually show a higher level of correlation. Now, one of the interesting things I found in this model is that the EC10 is more correlated with platinum than with gold. But nevertheless, in every single instance, the EC10 offers enhanced portfolio diversification and risk mitigation against all of these exchange-traded funds. So now that we have done that, we've actually challenged traditional notions of risk, and we've shown that crypto assets can be used as a tool to mitigate portfolio risk. Next, I want to jump into the discussion of value. And I'm going to also challenge traditional notions of value. So you may have heard the term value for money, right? When we talk about value in the context of cryptocurrencies, we sort of have to turn that on its head and ask, what is money for value? What I'm going to do is I'm going to start by looking at equity valuation models. These 5 models are used predominantly in industry by investment management firms, insurance companies, hedge funds, and banks to determine the intrinsic value of a company or an investment. And one of the more commonly used models is the discounted cash flow model. So I'm going to look at this one specifically. In a nutshell, basically what the model is doing is just taking an estimation of the future cash flows expected in the future and putting that into a present value today and then comparing that to the current stock price, right? And this is actually a core facet of fundamental analysis. It's a widely accepted notion of value in finance. So this was created by Benjamin Graham, David Dodd, and later propagated by Warren Buffett. And basically what the model says is, if the intrinsic values arising from your cash flows is bigger than the share price, you substantiate that investment decision, you buy or you hold. And likewise, if the intrinsic value arising from cash flows is less than the share price, well, then you sell. So this is a widely accepted notion of value in finance. But these models, specifically this model, is underpinned by a host of assumptions that render it ultimately subjective. I won't go too deep into it, but if you were to increase your investment horizon, you are increasing that intrinsic value. Inputs into the model, such as the constant growth rate and cost of capital, just changing these inputs by 1 to 2% can alter the intrinsic value by up to 2/3. And then finally, these models cannot account for future growth opportunities. Thus, these models are more subjective, I feel, than what industry is willing to admit. Now, don't get me wrong. There are legitimate proxies for value in equity: low price earnings, stable earnings growth, NAV at par or discounted share price. These are all great signals for financial strength. But the point I want to make today is actually that business model and utility trumps all valuation models. A good example is Tesla and Amazon. Not only did these models say 6, 7 years ago that these companies were overvalued, still today these models predicate that they are overvalued and you should sell them. And that's because they cannot account for true utility. And now this brings us to crypto assets. One of the reasons, or the major reason why the industry has gained so much traction in the past decade is because of the crypto asset utility. Bitcoin has ushered an era of a globally immutable, decentralized technology. It is not susceptible to the meddling of any type of intermediary. It has introduced globally near instantaneous payments and remittances, which the current fiat system cannot do. The DeFi sector has opened the door to lending, borrowing, insurance, and trading. NFTs extend beyond simply just the ownership of digital images, but they have opened the gateway to digital real estate, metaverse, gaming, Internet of Things, and even tokenization. Now, I could spend hours speaking about crypto asset utility alone. But the fact of the matter is we are seeing a digitally superior financial technology. Now, when Bitcoin first entered the fray, it sort of purported to replace the traditional fiat system. But what we're seeing is actually more of a symbiotic relationship between the crypto asset sector and traditional fiat money. So stable coins, for example, like Tether and USD coin, these have created a mechanism through which the United States dollar can actually interact with the crypto asset sector. Pax Gold, it's a cryptocurrency token backed by actual physical gold reserves. And the Argy token by Stefano, Marati, Argonon, and Renogen that we're actually building here at EasyCrypto allows for the physical redemption of helium gas, which is a project that I'm actually very excited about. Now, that is it for stablecoin utility, and the use cases are growing. And I've made the point that utility trumps all valuation models. And that's why it's the most important aspect of why the industry has gained so much traction. So I want to just end off my segment with some of the popular valuation models currently circulating around industry and just discuss them briefly. First up, we have Metcalfe's law, which seeks to quantify connection utility. Now, basically what the model says is we have a certain number of nodes in a network, and it tries to assign a corresponding connection utility value to the number of nodes. So if we have 2 nodes in a network, we have 1 connection value. If we have 3 nodes in a network, we have 3 values of connection utility. But now notice, as the number of nodes increases, the connection utility increases exponentially. Now, one of the limitations about this model is we cannot say with certainty whether 1 connection utility is worth 1 rand or $1, but we do know there is some level of utility in those connections. Now, another interesting model that's actually more popular in social media than it is in academia is the stock-to-flow model. It looks at the current supply of a commodity measured against that supply's rate of production, and it can be used for gold and platinum. But what we've done here on this chart is we've plotted the stock-to-flow on a logarithmic chart against the price and supply of Bitcoin. So the colorful line actually shows how the price of Bitcoin has aligned with the model over the past decade. So whether we continue to see an alignment of the price of Bitcoin with the model remains to be seen, but it is nevertheless a very interesting valuation model that many use to substantiate their investment decisions into Bitcoin. And then finally, let me end off this segment with my personal favorite model. It's called Benford's Law. And basically, to describe Benford's Law, it's essentially a series convergence phenomena. And it's very much Fibonacci-esque. And that's because it's one of those numbers that actually appear everywhere in nature. They appear in big data sets, from the financial system to even geography. And I can't go into the mathematics of it today, but I highly recommend looking into it. And one thing that I'm curious to see is how over the next decade or 2, whether the EC10 bundle is actually going to coincide with Benford's Law. I will be hodling until then, and I'll let you know if it does. But anyway, thank you for your time. Thank you for listening. Keep your eyes peeled for the new EasyCrypto investment platform coming soon. Thanks.
So
And guys, that was Don Kruger. That presentation was exceptional. Like you guys said, class was really in session. And I really hope that they teach this in school, varsity, and all of that, because that is needed. Up next, we've got Ciaran Ryan, who is the MoneyWeb editor for crypto. Ciaran, are you there?
Yes, I am. Are you hearing me?
Yes, we hear you clearly.
Good.
Ciaran, I know you will be talking about what will happen to crypto in the upcoming years.
Yep.
I can't wait to hear what you have to say, and I'll just hand over straight to you.
Great. Thanks very much. And thanks for all your listeners joining in this morning. I think EasyCrypto, what a great idea. MoneyWeb Crypto is about 1.5 years old at the moment. And of course, we started, really looking at traditional finance, but we saw that so many of our readers at MoneyWeb were invested in crypto and we were neglecting them. Hence, we started up, and a lot of the work that we've had to do over the last 1.5 years is really educating people on what is good and what is bad. And that is filtering out, what are the scams and what are the legitimate, what are the good names, the good hats, the white hats in this space. So that's what we've been doing. And I think we've done it quite successfully and built up quite a following and quite a readership. We do have content coming up pretty much daily on cryptos at MoneyWeb. So go over there and check it out. I thought maybe I'd just talk about my journey into cryptos. I started in 2017. I started with arbitrage. And for those who don't know what arbitrage is, that's where you're buying something like Bitcoin cheaper on one market and selling it more expensive on another. So you could, at that time, you could buy on Kraken, which is an overseas crypto exchange. You could buy Bitcoin about 5-6% cheaper than you could in South Africa. So you'd have to ship your euros or your dollars overseas. You would buy it on Kraken, and then you would bring that Bitcoin back to South Africa and sell it on an exchange like Luno. And I was amazed. I thought this was the best kept secret. And in fact, I was keeping it a bit of a secret, but I realized that there were thousands of other people that were doing it as well. And the crypto arbitrage market has become quite huge in South Africa, and it's often a way for people to get introduced to cryptos because it's relatively risk-free. You're not really exposed for very long anyway to the volatile movements that you have in Bitcoin and Ethereum and so on. But that crypto arbitrage gap has dropped. It's now at about net after all your costs. You're probably getting about 1%, whereas a few years ago you would be getting 4 or 5%. But it really did expose me to Bitcoin. I tried a little bit of crypto trading with some of these smaller coins and with Bitcoin itself, and I wasn't successful at that. So I dropped that. I'm a hodler. I'm holding. And there's a lot of good reasons. I want to get into that in a minute, why you should be buying and holding cryptos and not trading it. There are people who trade it successfully. It's just not something for me. I think it's often been said that Bitcoin and the blockchain was a solution in search of a problem. And if you think about that, what are they actually saying? Is the blockchain actually solving something that couldn't be solved by other means, by other technology? And I think what we've seen in the last couple of months in Canada, and this is something that really brought it home to me, where you had this trucker protest that was going on, and the Canadian government there seized the bank accounts of a number of these protesters. Now, whatever you think about, the narrative of these truckers and are they right or they're wrong, it's irrelevant. What the Canadian government has done is a frightening thing. And they've, apart from labeling people domestic terrorists, who were peacefully protesting, I think we should be terrified by what we have seen go down in Canada, because that may be a foretaste of what's going to come our way, and why, in fact, Satoshi Nakamoto, why he developed Bitcoin in the first place, because it's censorship resistant. That is one of the big advantages of Bitcoin. What do we mean by censorship resistant? Well, you cannot stop and veto a transaction. If I want to send my neighbor some Bitcoin, that cannot be interfered with by any government. You cannot get a bank to intercept that transaction. So it is completely free from any authority or regulatory interference. And I think that is, now we're beginning to see, and I think we will see in the years ahead, the use case for cryptos become more and more evident. Just on that point, Jesse Powell, who is the CEO of Kraken, that's one of the world's largest crypto exchanges, in response to what the Canadians did, this is what he said on Twitter. I'm just going to read this. due process is for plebs. Okay, plebs, that's us, the ordinary people. Might makes right in Canada. If someone dissents, you just confiscate their wealth, revoke their licenses, exclude them from the financial system, and kill their pets. No need to debate the law, policy, or even rights when you have a monopoly on violence. Okay, pretty strong words, but it does lay out the case there why. By the way, what Powell is saying is that you need to get your cryptocurrencies off centralized exchanges if you're worried about this particular development becoming more aggressive in the years to come. Okay, I want to talk now a little bit about Bitcoin as an asset class. We've had quite a bit of discussion today about DeFi. I'm not going to go too much into that, and also I think the presentation we just listened to, which was about the looking at the volatility and volatility as your friend, and I think that was very, very well put. Is one of the great attractions about Bitcoin and cryptos is how volatile they are. Of course, they can be tremendously dangerous, and cryptos for the time being, they have this kind of long only momentum behind them. So if you're going to be short cryptos, you don't want to be doing that too long, because the trend is on the long side. Okay, Bitcoin accounts for about 40% of all of the market cap of cryptos. Now, if you go back a few years ago, it was 100%, and then it was 95%. So Bitcoin's share of the total crypto market has come down to about 40%, and they call that market dominance. The rest of it, of course, is these smaller coins like Ethereum and Solana and coins like that that are coming up. I've just got a slide presentation here, which I'm going to try and activate. Sharing my screen. Please be patient. I think this is it. Okay. All right, I hope you can see that, and I'm going to start my slideshow here. Okay, where to for crypto? So if we're in internet years, we're basically in 1995 for crypto. Some of you might be too young to remember that, but in 1995, if you were trying to load an internet page, your favorite newspaper, it would take 5 minutes or 10 minutes sometimes. It was just crazy slow. That's kind of where we are with cryptos, that you're going to see a lot of development in the space, the speed of transactions, and I know it's very clunky and it's very user unfriendly at the moment. If you're going to go onto some of these decentralized exchanges like Aave, which was mentioned a little bit earlier, or Uniswap, and you're trying to negotiate, you want to grab those high yielding cryptos, the hundreds and the thousands of % that you can make. I know this sounds insane, but it's out there. But you've got to be very careful in what you're doing. You've got to know how you do it. I think one of the big developments we're going to see coming up over the next year or two is just simplifying that and making that user experience a lot easier. That said, one of the things that's going to happen is when that becomes a mass market adoption, you're going to see those interest rates, those high yielding coins, you're going to start to see those rates drop, and they'll drop quite dramatically, but they'll still be a lot higher than in traditional finance. Okay, talk about Bitcoin as a safe haven bet, and I hope you're seeing this. Bitcoin versus gold. Now, you saw gold has been doing nothing for the last couple of years, but then you've had this breakout of conflict between Russia and Ukraine, and you see gold shooting up there. The golden part of this graph here, that's gold, and the blue is Bitcoin. So Bitcoin is not really, it's been called digital gold, not quite. There is a kind of inverse correlation there with gold, but it's not a very stable one, and I see this potentially breaking. I think people see that there is good reason to, in times of risk, to adopt Bitcoin. One of the questions that comes up quite a lot is, for people who want to start, and they write to me, well, where should I start? I say, just buy a bit of Bitcoin. It's not going to be the most exciting. It's not going to be the fastest growing, but it's certainly something. It'll get you watching the market. It'll get you interested in cryptos generally, and you'll start studying up on it. So a little bit of Bitcoin, you follow that up with a bit of Ethereum. And I think the EC10 package is perfect for that, because it really just puts your attention, okay, what are the components in this and why are these doing so well? Just some interesting facts about, I just want to quickly show this other graph here, and I hope you've seen this too. There we go, Bitcoin versus the world. How did these all perform in 2021? Okay, Bitcoin was up 60%. Crude oil 55, the S&P 500 index was up 29%. And then if you look on the right there, the FAM index, that's Facebook, Alphabet, Amazon, Microsoft, and I guess that's Google at the end. That was up 37%. So Bitcoin is still outperforming, although it hasn't been quite as spectacular as in previous years. It's still performing very, very well. And here are the top 10 cryptos by market cap. You've got Bitcoin, you've got Ethereum, you've got Tether. Tether being a stable coin, it's always going to be worth $1. So if you're looking for speculative gains, you're not going to go there. But, once you've traded and you made some profits in Bitcoin and you want to get out of Bitcoin without leaving the crypto space, you can then just park your profits in Tether. And here are the EC10 components. Without the stable coins, you've got Bitcoin, Ethereum, Binance Coin, XRP, Cardano, Solana, and so on. Okay. I'm going to run out of time here pretty quick. So I think I'll just I'll talk about some of the problems that cryptos can solve. Now, let me just exit out of my share screen. Stop share. Okay. Okay, some of the problems that cryptos solve. First of all, we heard about Renogen and tokenization. That's a fascinating development. Just think about this. If you were to go and try and raise capital for a new business venture, you would go to the stock exchange. You'd probably spend a year trying to get all the compliances in place. With tokenization, there's another project that I'm aware of, an exchange here in South Africa. It's called Libex, Libex.ai. You can go there. They're starting up the first NFT marketplace in South Africa. And they have a coin there called Rare Earth Sanctuaries, RES. That is being used. They're raising $20 million to build 2 hotels in Victoria Falls. The first time this has ever been done in Africa, and certainly in South Africa. If that was to go to the normal stock exchange route, they'd be spending a year, maybe a year and a half, trying to get all of the regulatory compliances in place. They've had this thing conceived from conception to the date of listing. I think it was 6 weeks or less. So the speed with which this can be done, of course, because cryptos are unregulated, you can do it with this great speed. But tokenization is just a fascinating thing, and I think it is the way of the future. You're going to be able to tokenize real estate. You're going to be able to tokenize shares. You're going to be able to tokenize all sorts of things. So really keep an eye out for that. NFTs have already been mentioned. NFTs is fascinating because it gives a marketplace to electronic media. So if you're a digital artist or you're trying to know, you have a physical world asset, it could be a painting, you've got the Mona Lisa and you want to sell a little bit of that, but not relinquish total ownership away, you can tokenize it. Another big use case that we're going to see massive in the next couple of years is remittances. In Africa, remittances, that's from the diaspora. So people who, Zimbabweans living in South Africa, sending money back home, Ethiopians and so on, that's remittances. That's worth about 4 to 5% of the economies in some of these countries, but the costs of sending this money are huge. You do it through a Western Union or through your banking system. The World Bank estimates that's about 9%. You can do that through Paxful, which is a crypto-based company, for 1%. And that cost is going to come down and down and down. Even 1% is too expensive. And the speaker who spoke earlier about the threat to traditional finance, that's one area where they really are going to get hammered, the banks I'm talking about. Okay, stable coins. Stable coins are crypto versions of currencies, or not only currencies, but asset-backed cryptos. So you've got Tether, which is backed 1-to-1 by the US dollar. Supposedly, I'm not going to go into that. You have got Binance USD. You have got USD coin. These are stable coins. And there are some Rand stable coins, XR and ZARP, Z-A-R-P, backed 1-to-1 by the Rand. Now, one of the things that's going to happen, and I had an interview with Andre Cronier, who is the founder of Yearn Finance, which is a yield farming algorithm, basically goes around the internet and it hunts for the best yields that you can get. You can go to MoneyWeb and learn more about that. But one of the things that he's now developing is this alternative forex market based in the crypto space, based on stable coins. So you really are kind of looking at what are we doing here because I'm running out of time. I am out of time. What are we doing here is we're taking like the old record players that we got, the vinyl records, and we're digitalizing that. So the digitalization of all this kind of thing. Some of it's good, some of it's going to be a complete waste of time, some of it's fraud. But what an exciting time we've got ahead of us. And I'm finished.
And that was Ciaran, crypto editor at MoneyWeb. So go to MoneyWeb, check out their stuff, and up your smarts on crypto. Right, next we've got a girl boss. Well, that's what I'm calling her. She's a tech and privacy lawyer. Her name is Nerushka Bowan. And not only is she the director at Norton Rose Full Rights South Africa, but she's also a leader in emerging tech law and analyzing law and regulation around emerging tech like cryptocurrency and blockchain. She's also an international speaker, so we are so lucky to have her here today to chat to us. Nerushka, are you there?
Yeah.
Fantastic. All right, Nerushka, I'm going to hand over to you and you can take us away.
Thank you so much. Great to be here today. What an awesome lineup of speakers and so much interaction from this great audience as well. I'm here to talk about the legal and regulatory implications of cryptocurrencies and just shed a little bit of light what's been going on at a global level, at a local level, and also what I see for the future in the space. So at a global level, we've really seen three different approaches taken by various regulators when it comes to how they approach cryptocurrencies. We've seen this head in the sand approach, which means, kind of ignoring it. And, if I just ignore it for long enough because it doesn't fall within my regulatory ambit, perhaps it will just disappear overnight. Then we've seen a very combative approach, to the extent where we've seen some jurisdictions, for example, like China and Egypt, where they've actually banned some of the use of crypto in those jurisdictions. And then we've seen the collaborative approach. And the collaborative approach is where we have regulators actually engaging with stakeholders, trying to figure out how do we regulate this new emerging tech together, because they can already see it's going to have some kind of impact on monetary policy considerations, and trying to take that into account when creating regulations for the future. And we've also seen some jurisdictions already have crypto specific regulation in place. We've really seen a broad spectrum of approaches taken depending on where you're sitting in the world when it comes to crypto. So in the US, for example, we are seeing a bit of a combative approach from the SEC, which regulates securities. And what they are doing is something called regulation by enforcement. So they haven't issued, regulations or laws or legislation to say this is what those engaging with crypto products should do. What they're actually doing is they evaluating products on a case-by-case basis and deciding whether it fits within the existing regulatory ambit. So, today we decide this crypto product is a security, and because you didn't follow all the laws for security, now we're going to fine you X million dollars for non-compliance with our security law. So they're doing something called regulation by enforcement. And that's part of the reason why a lot of times when you see an exchange, for example, launch, they'll sometimes say, if you're based in the US, we don't actually want you to use our product, because they are afraid of coming under the ambit of that regulation by enforcement. Then we've seen other jurisdictions like Malta and Japan. They've actually produced documents that are very crypto specific and tells you, if you want to launch an exchange or an ICO, for example, these are the licenses you need. These are the processes you have to follow. This is the security you have to have in place. And what is happening is a place like Malta, for example, is actually becoming more attractive to people who want to play in the space because of the regulation. So you're almost getting innovation through regulation rather than regulation stifling innovation, which is quite interesting dynamic that we're seeing in the crypto space, because you would think, and a lot of people from a philosophical perspective believe we shouldn't have any regulation when it comes to cryptocurrencies, because the whole point of it was to exist outside of the traditional incumbent financial system. And the fact that we're trying to regulate it and bring it underneath the existing system goes against the whole philosophical idea of crypto. Now, yes, it's very difficult to actually regulate the underlying technology, and can sometimes be impossible to regulate the underlying technology. Sometimes what you just end up doing is driving the behavior underground as opposed to actually stopping it. But the level that the regulators are targeting is the intermediary level. So it's the people who are helping other people engage with the technology. That's the level that will require some kind of regulation. And this is stemming from consumer protection mindset. And it's because of the amount of scams we've had in the space, to the point of people actually losing their entire life savings because they've invested with somebody who's not a licensed financial service provider, gets their money's now gone because it was just a scam. There was no crypto product that was being invested in the background, and all of a sudden this person sitting here without any recourse, doesn't even know who's this organization that they invested in, and the regulators are saying we also can't help you because this is not an entity that we actually regulate. So because of the amount of scams that we're seeing, and because of the need to add a layer of consumer protection in, we're going to see regulation starting at that level, where we're going to have some kind of licensing regime or something like that. So from a consumer perspective, you can say, okay, these entities are actually regulated, they're following the laws. If I give them my money, I can have some kind of trust that they're actually going to invest it for me in a crypto and not, disappear tomorrow. So this is where we see the need for regulation coming. And the other reason for us seeing the need for this regulation is for regulatory certainty. We're sitting now in South Africa where we have no specific regulations for crypto assets. So every time clients come to us, we need to first analyze what we're already dealing with from a regulatory perspective, figure out, does anything in existence already apply, and then try to figure out, where do we think regulation is going, and then kind of give the client, okay, this is what you're going to do now, but in the future it may change to this. So it creates a lot of uncertainty. You don't always know how the regulators are going to react to a particular situation. However, if you have a regulation that tells you you need to do A, B, and C, and in order to launch your product, it actually will then start promoting innovation and promoting adoption, because people will be less scared to engage with the products, because they'll be less scared of falling for a scam when it's a regulated product, and we'll have more participants in the ecosystem because we have certainty about the regulation. At present, we're seeing very conservative approaches being taken by existing regulated entities such as banks. Some of them have made decisions to actually say, we're staying outside of the space because there is no regulation here, and we've taken a risk decision that we do not want to engage with entities who are active in the crypto space. So that's quite a negative approach for the crypto industry, to have large players like banks kind of excluding themselves, but from their perspective as a regulated entity, they don't want to put prejudice their banking licenses and their kind of trusted status by engaging in something that's not regulated. So what we have in South Africa at the moment is something called the IFWG. It's the Intergovernmental FinTech Working Group. It's where all the regulators in the space are actually coming together. Most of them are financial, but there's a few other regulators that are joining in, and they've drafted some policy papers basically saying, this is how we see the future of regulation for crypto. They've engaged with stakeholders to get input into those documents, and now we're basically in a waiting game to see where we go forward in terms of actual regulation being implemented as a result of those policy papers. What we can expect in terms of what might be one of the first moves is, in terms of financial service providers, we may see a statement or a notification including crypto assets as a financial product, under our financial markets regulation. And what that will result in is that people who are providing advice when it comes to investing in cryptos will require a license and become a licensed financial service provider in order to provide that service. So it's probably one of the first steps we're going to be seeing taken by the regulators. From a tax perspective, we've had statements from SARS already. Basically, if you're engaging with crypto, ordinary tax rules apply. So if you're an active trader and you're buying and selling on a regular basis and you're making profits here and there, it will more likely be a revenue or income for you, and you'd have to declare it in your income statement as an income or revenue in the ordinary course. If you perhaps bought a Bitcoin 5 years ago and you've just held it, and all of a sudden, tomorrow you decide I'm going to sell it, it's more likely to be a capital gain for you because of the nature of the holding. But at the end of the day, they've also said get your tax advice, because ordinary tax principles will apply to determine how you put that forward, from a tax perspective. One of the big changes we're waiting for is in the realm of exchange control. I mean, we've had exchange control drafted almost like a century ago for the purposes of moving cash across borders. Now we're trying to take those same archaic regulations from there and trying to apply to a borderless, future of money crypto asset, and it's causing havoc at the moment from a regulatory perspective. So the sooner we have development there, the better for the entire ecosystem in the country, and the sooner we have any kind of regulatory certainty when it comes to crypto, so that we know, this is what you need to do. Because I'm telling you, a lot of companies, they want to comply with what's put on them, but at the moment regulators are saying, it's outside of our ambit, so we can't even tell you what the steps are to take. So we're seeing a lot of voluntary compliance, voluntary KYC being done by exchanges and things like that. But having any form of regulatory certainty, I think, is only good. That's going to be good news, and help us retain that expertise when it comes to crypto, in the country. Where to from here? I think it's already been mentioned, but things like NFTs, the metaverse. The metaverse is going to open up another whole can of worms when it comes to legal and regulatory implications, which makes people like me very excited to unpack that. We've already seen a lot of intellectual property issues with things like copies of Birkin bags. If you know anything about luxury handbag sector, you'll understand what a sought after item a Birkin bag is by Hermes. And yes, there's a court case already with regards to IP infringement in the metaverse. So how that develops and the interactions with crypto is only going to be exciting, for this future world that we are moving into. So that's it from my side. I hope I gave you a nice little overview of what we're seeing globally and locally, and what I want for the future, which is, regulatory certainty to move this industry forward. Thank you so much.
Crypto is literally changing the world.
It is
I
changing.
never thought I'd say this. I used to be a hater. I'm reformed. But I think just from today's speakers alone, I've learned so much. My eyes are open. I cannot be left in the shadows about this amazing new technology. It's incredible. So I'm really chuffed.
So guys, we've converted one. Are you converted? I really hope that you are, and you know that if you're really still scared to test the waters, you can test the waters with the EasyCrypto 10 bundle, which is the top 10 cryptocurrencies that are weighted by market cap.
Yes.
So I think that brings us to the end of the crypto conference.
What about the winner? When is that happening?
So the winner of the $5 grand will be announced on Monday at 1 o'clock, guys.
Ooh, Okay, so keep your eyes open. We're going to be going through all of your tweets. It looks like you guys have had an awesome time, some really cool, engaging conversation on the chat and on our Twitter feed. Thank you so much for joining us and spending your Saturday morning with us. It's better than sleeping in any day.
True facts. And thank you so much for the speakers that we had here. It's amazing stuff. And remember, guys, they dropped the tea that the new crypto platform is coming in March. So look out for that one. Thank you, investors, and have a good weekend.
Bye, crypto freaks.
Jingle